Is the bullish momentum dead? I mean, really, the market only moved 0.3% last week, even as the final bullish indicator I've been waiting on flipped back to green. That's nothing considering that we had FOMC, the UK trade deal announcement, and some optimism on China tariffs coming down from 145%. Now, the actual negotiations with China are happening as we speak over in Switzerland, and I'm honestly glad that markets are closed. I'll take the hard pass on trying to trade these headlines. Seems to me that markets are more so waiting for the CPI inflation numbers this Tuesday and are almost preparing for a disappointing read. So welcome back to the Trade Brigade Weekend Show, where we'll take a look through all of the data points to make sense of this, and we'll build a logical trade plan. My name is Matt, and if you're new here, hit the thumbs up button and subscribe. For additional resources, check out the links listed down below in the description, and stay tuned until the end of today's show. I've got 2 additional trade ideas to share with you that you won't want to miss. With that said, let's jump right into the charts. So we'll kick things off on the SPY weekly time frame, talking about candle structure and location as we always do. In terms of structure last week, we certainly have an indecisive doji. All it would imply is that buyers could not find acceptance towards the highs of the upper wick, but sellers could also not find price acceptance towards the lows of the lower wick. It's really indecisive. Now, we do technically have a green-bodied bar, so the closing print is technically over the opening print, so maybe there's some subtle progress in the upward direction, but it's a great segue into location, because if we take a look, notice that on the bar-to-bar count, yes, we did produce a bar-to-bar higher low and an incremental higher high, but where did we close? Right back inside of the previous week's range. If this market did have momentum, we would have breached the previous week's high and attempted to close outside of the previous range, and that just simply didn't take place. We tested above and then closed back inside, which is much more indicative of balance, which really becomes the next key focus here. Is it reasonable that the market might fall into a balance or fall into some form of consolidation? I think the answer is absolutely. If we quickly measure from the low of the panic drawdown over here to the most recent high, this rally is just about 18.5%. 18.5%. Is it logical that the market might consolidate before making the next advance? I think the answer is yes. That advance could be up, it could be down, but some consolidation is warranted. Now, the next key question that gives us some directional insight might be, okay, is the location of this consolidation more bullish or more bearish? Well, I don't know about you, but we've been ranting and raving about this level right here. We really know it to be previous support, which acted as a first sign of resistance in the upper wick of the first rebound bar, but we've now closed 3 candles above, 1, 2, and 3. All of the consolidation of last week's balance was taking place above this key level, and I would think as long as consolidation persists above that key level, it would be seen as more bullish than bearish. We could also take the approach of using Fibonacci's and coming in from the all-time high to the low of the move and just reinforce the idea that if this was technically going to remain a bear flag, if this was bearish consolidation that we were dealing with right now, we would have been looking for consolidation underneath the Fib 38.2. That's just not what we have. We now have 2 weeks that have closed over the Fib 61.8. And as we know, the more weekly bars that close over that Fib 61.8, the higher the likelihood of a 100% retracement. So that is bullish. Now, if we come in with the fibs from the lows of the move to the most recent high, you'll notice that the Fib 38.2 here is technically underneath this area, which is 550, 551 if you want to split hairs with me, right? If we're under that level, is it still bullish from a fib perspective? Yes, although I wouldn't really want to see prices underneath 550. We'll talk about the key line in the sand on the daily chart in just a moment. Point being is that it's reasonable we might consolidate over some of these key levels. Now, if you're a mega bull and you're like, oh my God, I just want to go back to all-time highs, what you need here is a change in weekly trend, because let's not be oblivious or ignorant to the fact that we still have highs, we have lower highs, and this very well could be a technical lower high. The issue for bears is just that ideally the higher low consolidation happens over this key level from back over here. So again, to be extremely bullish, you would need to take out this level here, which is much closer to 575. If you get a weekly higher high over 575, it is no longer fair to say that the weekly trend is down. Let's see how we managed in terms of our anchored VWAPs last week. Let's take a look at this spread here. Notice that we are still rejecting the previous all-time high anchored VWAP from back there. It's the weekly 50 SMA in blue, as we've noted. It's a reasonable place for this consolidation to happen. And once again, look at this. Beautiful. Previous pivot low is confluence with literally the all-time high anchored VWAP. As long as price is above that, I would be sort of hard-pressed to fall more so into the bearish category. I would want to remain a little bit more optimistic here on the higher time frames. Let's take a look at our good friend, the volume profile. Zoom out here, and let's see what we can see. Any additional insights from this? Here's the high volume node, the top. Really, you could section this off as a big high volume node. It's this in here. You're obviously rejecting the top end of the extreme there, which is, again, a reasonable indication that you might pull back or consolidate around this area. If we split hairs with this high volume node, we technically closed the weekly bar above that one. And once again, more so in alignment with the Fibonacci's from A to B up here, you could still technically pull back and remain in the high volume zone, this right here, as long as we're over, what's the number? I'll get you a number here real quick, loosely about 543, right? The Fibonacci, if we come in from the low, I think it was a little bit underneath that actually, 535, right? So the Fib's a little bit more generous, the high volume node is not so generous, but regardless, it seems to me that there are green shoots here on the weekly time frame, and remaining overly bearish after a week's worth of consolidation is kind of the improper approach. To be a bear, I would at least need to see a breakdown of the 550 with a lower high here. It's a great segue to the daily time frame chart because that's really where the picture becomes a little bit more clear. Let's firstly evaluate this week's expected move. If you're not familiar with this study, check out the video tutorial in the top right-hand corner. Shows you how to set this up. If we're contained by the upper bound, the number's 577.75, and that of course would imply a higher high in the daily trend count. Don't worry, we'll zoom in just a second. If we're contained by the lower bound, the number is 551, which is still above the key line in the sand. This is the level that must hold walking forward. It's not the 551 weekly level we were just talking about. This is that previous lower wick. It's really the top end of the tariff turmoil zone, which is why I'm going to give the chart the benefit of the doubt and some breathing room towards that weekly zone, right? 551 to something like 546.75 is still the spot where I would be seeking some kind of daily higher low. Because keep in mind, if we're thinking about the daily trend count, I'll zoom in a little bit further now, right? So we can see this. The daily trend count is that we have lows, we have equal lows, which were higher, undoubtedly, from here to here, and we have not fallen into a constructive hourly downtrend ever since this pullback. So that means that this gap and go is a soft higher low. This is a soft higher low. The bottom end of this consolidation is a soft higher low. If the hourly trend is going to flip to down, perhaps in hindsight, we would label this some sort of daily double top. The hourly trend breaks to down when and if we're underneath 558, and I'm still thinking about, just like last week, how this zone down here can offer the opportunity of a firm daily higher low in the trend count. Just to make sure we're all on the same page, we can afford a pullback because we are pulling back from the highest high in the trend count as well, right? We have highs, we had equal highs, we broke out for higher highs, this was a higher high, and even on Thursday intraday, we did set a new higher high. So it's very reasonable that the daily trend will remain up and we can seek a higher low in the trend count so long as price remains over 546.75. That would also satisfy bullish consolidation on the weekly chart that we were just evaluating. If we pull back beyond 546.75, the weekly can still suggest a higher low, which would be more in alignment with this gap close down here. We'll label that as potentially a weekly higher low, but to get there, I absolutely would be concerned if price is underneath 546.75. I mean, don't get it twisted. If the market ends up looking something like this, that is concerning. Let's just say that talks over the weekend with China go horrifically. Let's say that Donald Trump decides to put 200% tariffs on China, or just generally makes it worse in terms of trying to negotiate a deal. If that's the case and we get a lower high underneath this level, then yeah, we're back in the tariff turmoil zone. We will be very open-minded to a daily trend reversal and some sort of look above and fail on the zone as a whole, which in theory would target the bottom end. Now, what I've just outlined here is a hypothetical. I don't know where futures are going to open up on Sunday. We'll sort of post on X and we'll be watching that very closely. But for now, given the data that we have in front of us, this consolidation is taking place in a bullish location. It's over the top end of the tariff turmoil zone, and I'm going to continue to maintain the stance that a daily higher low can be found here if the market pulls back. And as of right now, inside of a balance, I would say that there's no indication of a pullback until we lose something like 558. Now, I want to continue to keep making this comparison back here. We remember the V-shaped recovery that took place after the yen carry trade explosion, right? We went into a phase of consolidation, a phase of balance, reasonable, near previous resistance, right? Reasonable, consolidation, near previous resistance. If the market pulls back, this higher low is what we're looking to capture right here over 546.75. So I would welcome the breakdown underneath 558 to give the opportunity for buyers to step up here. It would be more advantageous for risk reward longs back to the daily 200 SMA, and then we'll look for follow through. So that's the daily narrative here. Now, obviously, if the market just consolidates inside of this range and breaks out, I would still be cognizant of the risks overhead buying into known resistance. That is that weekly level we were just talking about around 575.50. The market needs to clear that and then offer this opportunity for a higher low pullback above something like 569 if it's going to be a balance range break, pullback for the Brigade bolt above, and then follow through into the overhead supply level, which is 590.25. So if you're an optimist here, you're probably thinking that the balance persists, there is no pullback, we break out, I would Brigade bolt over the daily 200 SMA, and over time, that target would be 590.25, which comes from, as we all know, this balance range off to our left. Let's get a little bit more granular. Let's get on down to the hourly time scale. There's not much to read into in terms of nuanced price activity on the hourly time scale. I mean, really, there's just a gap fill reversal on the Thursday session. There's, as the UK trade deal is announced and all of the commentary to follow in the press conference, there's this euphoric move into known resistance, and the market pulls back and unwinds it into the close, right? If you've been watching the market intraday, it's been doing this thing where you rally and fade, you rally and fade, you rally and fade, you rally and fade. This is just total volatility on Wednesday's FOMC. And then here, you rally and fade, giving back all of the gains. So what's the main takeaway here? For us technical traders, it does not appear as though we have what I would consider, not what I would consider, but what's dubbed the OTF, the other time frame participants, higher time frame participants, really entering this market with a lot of strength and confidence, which, once again, if we think about what we talked about on the weekly timescale, is that reasonable? Of course, why would they want to enter this at the highest high? It would make more sense that perhaps other time frame participants are looking for a higher low pullback to get involved at either slightly lower prices to have better entries, or they need some sort of clarity out of the outlook to bolster a new phase of momentum to the upside. And that could very well happen, but we would need to break out of this hourly balance range right here. If we just get back to basics of technical analysis, what's the trend in this box? There isn't one. We have, if we want to count this real quick, highs, higher highs, lower highs, higher highs. Then we have lows, which are technically higher from here, which are equal to back here. There's no trend, right? So be my guest if you want to scalp in this range. And, it's really been kind of a grind, I'll admit, over the last week and a half or so, really, as the market's been more so sideways. It's been tough in these grinding boxes. So I wouldn't fault you for saying, I'm not going to do anything in this market until we clear 569.75 or break down underneath 558 to offer that pullback in the first place. So if you had to ask me, what is the pathing? What are the ideas? I'll tell you once we take a look at the Fibonacci's and the anchored VWAPs. If we come in from the low of the last major pullback, this being the pullback, right, to the high, the Fib 38.2 is still right here, confluence with our ideal level at the 546.75. We could come in from this low also, just to get a quick check. We're still over the 61.8, which is the weekly level, all set from that perspective. The bottom end of the hourly balance is technically the Fib 38.2, so I would consider this more bullish consolidation rather than bearish consolidation. Same concept as what we described on the weekly. If we come in here with the intraday anchored VWAPs, we're above the entirety of the cluster, and I've added the anchored VWAP to this gap up, which was Thursday of now 2 weeks ago, just to give us a little bit of an over and an underline. And notice that this week it was very clear, right? Acting as resistance early on in the week, then acting as support once we got above later on in the week. So would it be more constructive to stay in the short term over 562 and put in consolidation here, technically resolving an hourly higher low? Of course it would be. But generally, right, it's not unreasonable, as we've said just a moment ago, to wait for a break out of this box. All right, so the simplified pathing, let's just remove those anchored VWAPs to clean up the visuals here just a bit. Let's put this front and center, and I'll give you what I'm looking for. Be my guest to trade around in here. If you're going to trade around in this range, then tune into the pre-market preps. We'll give you those literally day-by-day game plans. The higher time frame pathing ideas where I'm definitely more confident instead of just scalping the market. Brigade bolt to the upside, sure thing. Thank you very much. Come again. That's over 569.75. If we can spot higher lows here, great. We will target 575.50. If we go beyond that, right, we know that this is the weekly breakout. This would be the next Brigade bolt to the upside with some sort of respect to 578.50 upper edge of the weekly expected move as well. All right, so a little hesitation here might be reasonable, but really that 584 is the next major overhead target. If the market gives us look above and fail, I would not short if we are over 567.75 coming from this previous high, which acted as consolidation lows post press conference from Donald Trump on Thursday with the UK trade deal. I would wait and say, okay, this is starting to signal look above and fail, lower high here, but the short would be the Brigade bolt here for the rotation at least to 562, if not the bottom end of the range, right? That would be 558 down below. That's if we get a test above that fails, right? Look above and fail, rejection perhaps of the daily 200 SMA. It's a short I would be willing to take because risk reward is very clean to the downside on a failure pattern. If we're just consolidating and going sideways, you could try to buy support. You could try to do whatever you want in here. As I've said, it's not all that interesting from a higher time frame perspective. If we do get a move to 558, my first thought would be look below and fail. Just as a range rotation, I would be willing to try something that looks like this, right? Risk reward to the upside. And if we just Brigade bolt straight through it, I would say that this unlocks the move into this zone down here, where, as we all know, the daily higher low is my top priority between 551 and 546.75. That could mean it looks something that looks like this to get there. Then it is, let's just say, one of these. Why did I draw it this way? Well, because you sweep this area, and then a higher low back over 551, which is the weekly level we just described, that would be an entry point on the higher low. What would the ideal target be? Something that looks like this. There is a threat on the back test of the 558 undoubtedly, but if this is going to persist as a much firmer daily higher low, this really shouldn't offer much. So you'll learn something either way on the test of 558 if you can spot this entry long in the first place. All right. Another opportunity could just be something very simple, right? Where you come down, and let's just say it's a simple double bottom. You could say, okay, I want this higher low back over 558, in which case I would be long here, expressing risk reward on the heels of a daily double or an hourly double bottom to establish the daily higher low. Right? If everything's going to go to hell in a handbasket, if Matt is going to be wrong in the bullish base case, the perma bull of YouTube is wrong, as I've been before. I'm not right every time. Right? If we get something that looks like this and we consolidate here, this is run for the hills. Oh my goodness. Sayonara. Nice knowing you. And what could be the catalyst, right? As we know, Tuesday morning, 8:30, CPI inflation report comes out. Is it way hotter than the market expects? The market's not dumb, right? It's already forecasting that it's going to come in hot because of some of the tariff and the pull forward that's happening there. But is it hotter than the market anticipates that it's going to be or not? So we'll be live up here in the office at 8 o'clock, as we always are every single day. For the pre-market prep, we'll see how the CPI influences price in real time. Come join us for the show on Tuesday morning in particular. And with that, let's jump on into some supporting evidence, meaning our market internals. If you're not familiar with this dashboard, check out the video tutorial in the top right-hand corner. What do we see? As the market's consolidating, who has the edge at the exchange level? Is it bulls or is it bears? Well, the only substantial volume flows that we had all week at the NYSE were in the upward direction on Thursday, up over 300 million. That is bullish. Everything else, much more muted, much more mild. If you look at net flows on the week, they've technically closed mildly green. Again, very indicative of balance. We're not refuting. There is no divergence. The market is in a balance range. That's fine. But who has the edge? Probably more so the buyers. If we're thinking about the advanced decline line, a little bit more split here. There's a couple of days, Monday, Tuesday, under the zero line. Wednesday, Thursday, Friday, all above the zero line. Probably a small bullish edge there. If we look at the cumulative builds, bearish, kind of mild, a little bit more bullish and mild. So I don't know about you. Let's say that these cancel each other out. This is mild, this cancels this out, bullish and bearish. This is mild, this is mild, this is mild. It's really, nobody has an edge on the intraday out of the cumulative tick here. The only thing I think that you might read into slightly is the idea that because there was such a strong volume expression on the Thursday session, the fact that buyers could not continue to materialize this consolidation on the highs might be a subtle indication that buyers could be trapped here towards the top end of the balance range. That is a possibility, and I think that for our base case, right, if we are underneath in the ES for the open on Sunday, or the SPY on Monday, whatever you prefer to watch, if we're underneath 567.75, these could be trapped buyers, and you could just be in store for balance, right? It's not an indication that oh my God, the market's going to crash. It just means nobody's really getting paid. You're probably not going to see momentum, right? There's no follow through based on what we've seen expressed here on that Thursday session. Let's take a look at the market profile, which in an interesting way will also show us, right, that there is that trapped overhead supply. The point of control did move higher on that Thursday session, and we certainly developed value lower on Friday. Point of control was lower. If you take a look at A and B periods, it's a direct sort of lower high underneath that trapped perhaps, quote, overhead supply. So once again, is it reasonable that the market opens in more of a balanced state, not allowing those buyers to sort of squeak out a profit as soon as the market opens up, or they didn't get follow through on Friday? I think the answer is yes, right? And by the way, if you're not familiar with the market profile, video tutorial, top right-hand corner, check it out. Generally, we do have poor high, poor low, excuse me, on the Friday session. A, B periods here, C, H periods over here. It's an inside bar on Friday, which simply means that, again, it's another indication of balance. You could take this another step in the opposite direction, too. This is really only a market profile nuance that you could see. If you look at this, right, this is the Wednesday M period spike. We know that Thursday held above. We talked about that in the morning show, but Friday inherently held above as well, right, which maybe goes a little bit overlooked because it's an inside bar to Thursday in the first place, but we're still over the spike of the M period prints from Wednesday, which could be an interesting carry forward just to sort of balance out the analysis of saying, okay, we have trapped overhead supply, but in theory, I mean, anybody who bought that spike into the end of day of Wednesday still feeling okay about the positions as of Friday's close. So all of the indications I'm seeing so far is that the market is certainly balanced. There's a lack of momentum. I mean, that's quite obvious, right, as the market's gone sideways now in this box. But the location of this balance is not overly concerning. As a matter of fact, it's a little bit more compelling on the long side than it is the short side. That's my take on the S&P 500. Let's take a look now at the QQQ NASDAQ 100. Let's jump this up to a weekly time scale. Clean up the drawing set, and we'll see what's going on. So weekly chart, very similar to the S&P in terms of candle structure and location, right? You've got yourself the same look as a doji, indecisive, no buyers, no sellers in the upper and lower wicks there. Closes right back inside the previous week's range, rejection of the weekly 50 SMA. Notice, though, that this is much more of an equal high. So yes, it's balanced, but is the weekly trend down here on the NASDAQ? I would say the answer is inherently no as of right now, right? You have highs, you had a lower high. This is now an equal high. Equal highs are not in the vocabulary of a downtrend, right? So equal lows can be, but certainly not equal highs. And now, once again, if we just use that same pivot reference from back here, previous support acted as resistance, it's acting as support, and all of the consolidation is taking place above. So I don't want to bend your ear off and say the same exact things out of the S&P, but it's almost a mirrored reflection. Let's take a look at the anchored view apps. You've actually closed above the previous all-time high anchored view app here. You're well above this anchored view app as support from the all-time high. That's bullish. If we come in with the fibs from the lows up to the highs, well above the fib 38.2, from the highs down to the lows, of course, well over the fibs. Sorry, caught myself. Not quite closing over the fib 61.8. The upper wick tested above, but not quite a close. Nonetheless, bears, you're not able to call this a bear flag on the higher time frame. You would need price acceptance underneath that fib 38.2, and you're just not even close at this point in time. Let's clear that up. Let's take a look at our volume profile on the weekly time scale here. Do we have a similar indication? It was different, right? The high volume node is much more pinpoint precise. We've closed above it. We've closed above it out of the NASDAQ, which is a more bullish than bearish indication. So long as we stay above it, you would think that there is now demand underneath us. You could use that as support instead of acting as resistance. So bullish on the higher time frame QQQ, very similar to the S&P with some subtle nuances from a fib measurement perspective. So take a look at the QQQ daily time scale. Let's firstly evaluate the weekly expected move. Upper edge is at 501.71 up here, implying a higher high that's bullish. If we're contained by the lower bound, it is a breakdown underneath these lows, which did make a more substantial lower low on the QQQ. We'll talk about that on the hourly chart in just a second. I would call this an equal low. I wouldn't really call it a daily trend reversal. And if I'm being quite honest, I would say that anything that persists over this level here at 465.85 gives the opportunity for a daily higher low. We have lows, we have soft higher, this is a firm higher low, my apologies. This is still that same thing as the S&P. This is where you start your soft higher low, soft higher low. This maybe could be a firm higher low, just noting that the hourly chart did technically breach the bottom end of this gap up bar to close the gap. There's an hourly downtrend there, but it was very, very short-lived. It happened on a gap down, as a matter of fact, right? You can see that we opened technically here, closed the gap above. You know, it's sort of madness on that Tuesday session. Regardless, daily trend, I'm calling it as up, and I'm still optimistic about the daily higher low being over this 465.85. We've actually touched now the daily 200 SMA a number of times, and honestly, this is a more bullish indication here. A more bearish market that is like, okay, let's sell everything, it's time to bail on this. You'd get your first test, there would be so many orders sitting at that level at the daily 200 that either number one, you wouldn't make it there in the first place, you would front run it, and just the sheer number of orders ahead of it would prevent you from getting there, and the market would react firmly. or you would test it and it would just be a firm reaction. You would already be underneath something like 465.85 instead of testing it after what you could already call a higher low, right? Remember, equal highs in short proximity of time, after setting a higher low in an uptrend, the odds would favor a break through the equal high, right? So I'm not seeing this daily 200 as a big roadblock as of right now. If it was, you would see it on that first test. Now, again, mark my words, right? Of course, I say something like that, and of course the market's going to break down and do this. That's fine. If you want to look at this as a nuanced double top, I would certainly suggest so from the hourly time scale, not the daily time scale, hourly time scale. So let's get there now. Let me actually just show you before we get to the hourly. On the daily chart, if we break this level, right, you have a pivot high here, and then this is the monster above, right? 510 is the monster level above. Okay, so keep that in mind. But 502.65 is this previous lower high as the downtrend really became emergent underneath the overhead supply. Okay, so on the hourly chart, we can start to see this a little bit more firmly as a potential double top. Let me zoom in even a little bit further. There we go. If this is going to be your double top, of course, we know it only triggers when and if the neckline breaks at 477. So you would have to not only fail underneath and into the 2-day balance range from Tuesday and Wednesday, so you get here, fine, right? And then beyond that, you would need another lower high underneath something like 477. And notice that I've drawn in no regard for these previous highs. That, in theory, is probably wrong. There's probably something that can take place here on a firmer retest of previous resistance that can now possibly act as support. That's 473. So if we look at the QQQ, once again, this is maybe a little bit more firm of an hourly downtrend where you did breach this. There's undoubtedly lower lows here and lower lows here, whereas the S&P was much more so sideways, right? With that, if this is going to act as your daily higher low, you probably just don't want to revisit that. I think that this just totally combines with the double top analysis, right? If you get there, it's kind of a threat for downside, right? Now, when it pulls back, if we pull back, daily higher low here, daily higher low, I'm still going to maintain that stance. You got 473, and then you've got 465.85. So Matt, just give me the simplified pathing. Like I said in S&Ps, not until we do the Fibonacci's and the anchored VWAPs. It's coming from the lows up to the highs. Fib 38.2, kind of spot on with our key line in the sand area of support, 465.85, all set. Coming in from this level up to our new high here. The Fib 38.2 is kind of in no man's land. The 61.8 is reinforcing that 475, 473 zone. I would watch out for that. Once again, if the market pulls back, this is a place where you could easily get buyers stepping up over previous highs here. What was once resistance, resistance, resistance can now act as support. If we take a look at the anchored VWAPs, how are we faring on this front? We are above all of them. This cluster is mainly telling me once again to keep that optimistic stance about the higher low persisting over 465.85, and as we said in the S&P 500, it would be ideal, right, if the market opens and stays over 485 and then gets a Brigade bolt up and over the daily 200 over 493, gives you the clearance for those upper levels we were just talking about on the daily, 497.50, 502.65. Beyond that, you have that monster at 510 we were just referencing. So what does the pathing look like? What are the ideas? What's the name of the game as to how I am looking for this to unfold as the market opens up? Well, because this is a little bit more of a delineated balance range, I'd be a little bit more open-minded to, say the market opens here, pullbacks to, let's use a crayon, please. Pullbacks to 485, I'd be interested in possibly watching for the higher low to persist. If that's the case, coming back into the equal high after an hourly higher low would be bullish. If we just get the hook straight into this level, it probably doesn't offer risk reward to be a brand new money buyer just hoping, right? You never play the hope card in the market. You don't want to hope for a breakout there. You want to let the market break out and then offer you the Brigade bolt entry above to then target those upper levels we were just referencing, right? That's over 493, trying to get involved on that. I would be open-minded to trying the long here, even though it looks like the midpoint of the range, just because the delineation is a little bit cleaner here in the NASDAQ versus the S&P, right? So that's 485. If the market Brigade bolts underneath 485, I'd be less inclined to take shorts through this level, or through this area, this zone, if you will. I'm really not fond of trying to short the market there. If you want to be quick draw McGraw, be my guest, but the better structure, as we just described, would really come from a breakdown underneath 477 to then start attempting this daily higher low zone. closer to 465.85 with respect to 473. So I would prefer to trade these two in the upside. The only short, I'll just put in a larger white dot here, would be underneath 477 for maybe a little bit of that hourly double top action we just described, but don't overstay your welcome. Still thinking about longs, 465.85. Let's take a look at the NASDAQ side of the market internal, see if we can learn anything different about this side of the exchange. Much stronger volume inflows on that Thursday session, and that's pretty positive, especially noting what happened with the NASDAQ and Google in particular on the Wednesday session, right? As soon as that announcement came out and sort of sent the market lower, just pretty ugly. And yet you did not have strong volume outflows on Wednesday. So bullish here, small edge, right? We're still arguing that this is mostly consolidation on the daily time frame chart. Don't get me twisted. So small bullish edge volume-wise, you can see that here as well. The advanced decline line spends 3 days trying to stay over zero. Certainly Friday, not really compelling. It falls to zero and under zero. Kind of neutral. Like, I wouldn't call it bearish, right? Because if the bears were in control, these days would have been sideways here. This would have faded, and this probably would have drilled even deeper. More so neutral. I think that the data points are balanced there. If we look at the cumulative builds, much stronger on the bull side Thursday, kind of outweighs your weakness on Monday, Tuesday, pretty flat. Maybe a small bearish edge on Friday there as markets pulled back. I think it's, again, everything here just tells us that participants are dialing it back. You're not getting new money participation, even as the market rallied big time on that those comments about sort of the next progressions, if you will, of tariffs in the UK trade deal press conference. Anyhow, point being, internals-wise, no new commitments, but at least it's not a bearish divergence. I would be sitting here and ringing the alarm bell like crazy. I'd be saying, hey, do not buy the daily high or low if we had bearish divergence, right? If we had big cumulative builds on Friday, if we had a nasty breath flow on Friday, if this was down here all Friday, I'd say, hey, I'm going to think twice about buying that pullback. It's just not what we have. We do not have that as of right now. It's pretty mild at the exchange level. If we take a look at the market profile, let's take a look here. Zoom it out so we can maybe see a couple of sessions. We can just look at the week. There we go. So same comments. One carry forward here that's slightly different is just that there's a much poorer high on the Thursday session than the S&P. You can see a small string of single prints in B period here out of the NASDAQ. I don't really think it changes the idea that this poor high, first of all, could use repair. And then secondly, there's trapped overhead supply in this value area and point of control shift. On the Friday session, it's certainly lower, but just like we talked about in the S&P, instead of even testing the base of the spike, Friday's low is actually over the spike from the Wednesday session in the first place. And let's also not forget that J period, great excess low on that session. That's a pretty strong base to be rallying off of, basically. No pun intended. With that, jumping back over to the platform for the IWM. Let's take a look at our final broad market index and see what's happening on that weekly time scale. Let's take a peek, and as we know, let's grab more time here. The big threat on IWM is this box from in the past coming back to haunt us. Previous resistance, acted as support briefly here. The test briefly acted as support. We've technically closed over the top end of the box, excuse me, and it's a step in the right direction. Are we out of the woods from a weekly trend perspective, though? The answer is no. If we zoom back in here, you can still see clearly that the trend count is that we have lower highs. There's still a very clean opportunity for a lower high, whereas the NASDAQ is much more of an equal high. The S&P, I'm not going to say it's a clean equal high, but it's right there. It is right there, right? You can see also, if I do something that looks like this, we've closed above. If we use some more of those bottoms of the bars, though, hard to say that it's overly compelling on the upside. It's teeter-tottering. It's right on the edge, and I think that the CPI print on Tuesday morning will have the answers for us as to whether or not we get this or this for the week. If we take a look at some Fibonacci's, let's quickly come in here from, first of all, the local, well, not local, but the all-time high to the lows. We have just barely cracked above the Fib 38.2. Remember, the NASDAQ and the S&P are trading up here near the 61.8. You can see the bearish divergence, right? It's quite clear. If you come in from the lower high, have we recaptured the Fib 61.8? The answer is no. If we come in from this one, we certainly have, doing something along these lines. We are now using that as support in the lower wick of last week's bar. So you might say something like 595 could become a line in the sand. And well, ding, 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 as we move down to the daily chart in just a second, you'll see that that is a key level for the upcoming week. Let's take a look at the anchored view apps, though, first. We're still tangled up in a slop of them. Instead of clearing some from the all-time high, this lower high, it's not as clean. The IWM is not suggesting to us that, hey, it's all good, we're in the clear, let's start rallying. Right? You're not seeing that. Let's take a look at the volume profile. We haven't done this in a little while out of the Rusty side of things. Let's take a look, and it's really because it's just it's kind of funky to look at. But what do we have here? We're technically over the highest volume node point of this chunk, if you will. I would think that maybe gives us a subtle bullish edge. So what we might say here is that we're going to give the bulls the benefit of the doubt, but boy, oh boy, they are treading on thin ice. Any sort of reversal back down underneath something like 197s, 195s. Let's just go to the daily time scale, and I'll show you the key level here. Let's go IWM. Yeah, it's 195.15. If we break down underneath this area right here, right, that's kind of like game over. Why would I say that? Well, because if we're thinking about the daily trend, and then we'll get to the expected move, we have lows, higher lows, higher lows. This was a clean high or low, right? Because these previous lows were violated. We did see a move to the downside, and then we found support over this breakout level. So you have your 195.15 line in the sand. This zone is where the weekly lower high can persist. Now, the worst thing that could have happened, which did not happen, right, is that on Thursday, if we opened in range and broke down under 195.15, that would have been a really bearish close, right? Because the weekly bar would have been red, first of all. But something like this, with a little bit of an upper wick given from the Monday session on a weak close, would have been a rejection of the weekly lower high zone. We did not see that. So once again, we're giving the buyers the benefit of the doubt, but they are treading on thin ice. If there's any sort of breakdown back below 195.15, I would use this as a little bit of a warning shot across the bow for the S&P 500 and dial back some of the bullish, euphoria. Let's just say it this way, right? If the IWM is divergent from the S&P this upcoming week, the S&P is trying to break out of its balance range, and small caps are like, no, we're hanging out down towards 195.15, threatening a breakdown of what could be just considered like double top neckline. That would maybe make me think twice about the size I use on the S&P if I'm fishing for longs there, right? Now, if the NASDAQ is just up and away, remember that the NASDAQ will always overshadow the IWM divergence just because the S&P is more like basically a third tech at this point. So anyhow, that's the way I will be using this into this upcoming week. Those are the key zones. You can see why it makes sense on the weekly time scale. We can get a little bit more granular on the hourly time scale and just say, if the hourly trend is going to form as up and continue to form as up, the ideal thing that buyers would attempt to do here is keep price over $200.25. If you see this consolidation on Monday, Tuesday, great. Buyers trying to make a stand. Ideally, the next follow through would just be negating the weekly lower high threat that's between the 202.75 and the 198.25. If you see this, okay, a little bit of a sigh of relief, probably being a little bit more confident in that S&P 500, right? So that's the trend count here. That's what we saw on the daily. The expected move for the week, I know I said we were going to talk about that on the daily, but here it is on the hourly. Lower bound, 194.41, and the upper bound at 207.21. It's bullish here, I would say, on the higher high, and maybe a little bit more neutral on the bottom end with kind of an equal low to our line in the sand at 195.15. Quick check-in on the anchored view apps intraday. Above the cluster, anchoring to the same place that the other index balances started at. Notice that we're above that, and there's a little bit more of a clean trend here, actually, in the upward direction, ironically, in the IWM, even though the weekly chart is lagging. It seems to be playing a little bit of catch-up, but what you don't want to do is take the catch-up trade in a recovering market. You want to take the catch-up trade in a raging bull market, right? If you see laggards in a raging bull market and the broad market pulls back, you can long those things. That's where you play the laggard trade. You do not play the laggard trade in an early stage recovery. You want to pick the true new market leaders, right? So that's my take here on IWM. Hopefully that is useful to you. Let's take a look at the internals for the Russell side of things. I would say similar commentary to the S&P NASDAQ. Better volume inflows, a little bit of a mixed bag here on the advanced decline line. Much more bullish tick cumulatively on Thursday, but perhaps just even weight with the 3 days that were bearish here. Even technically Wednesday closes slightly red on the cumulative build. Nothing earth-shattering. Not, oh my God, small caps should be at zero. But just, maybe evening out the upside we saw from Thursday. With that, we will finish up the broad market indexes with the, the, at a loss for words and a cough at the same time. With the market profile, what do we see here? Same thing, right? I won't steal your time. Same thing. right? No, nothing new. The only thing that's different, no M period spike from Wednesday. That's the only thing to carry forward. What does it mean? Probably just means that watch the trend structure more so than the nuance of a balance range, right? You want to see the hourly trend persist on the IWM, not break down, right? There is no nuance in the balance range that you want to read into with the lack of the M period spike. Okay, with that, S&P sectors, let's get back over to what feels like home base. Look at that. Feels good. What do we see? Weekly performance of the S&P sectors. Who was leading, who was losing, and where was the weight? Leading the pack is semiconductors, up 2.94%, followed by energy, and then the tech sector here at the bottom end of the barrel. It's healthcare getting bludgeoned there, down negative 4.03%, staples, and then real estate followed up. So is this a risk-on rotation as the market's balancing up here? Yeah. Certainly seems to be so. If we had the market pressing and trying to make new highs and successful at it with leaders such, let's just say that this was positive, XLP, something like positive 3%, warning flag, it's just not what we're getting. As the market consolidates, sector posture does not really seem like a big deal. So let's breeze through these charts, and the key question we just want to ask and answer is there any threat for the trend to reverse? Well, here on the SMH, we're sitting on the highest high. We've just produced a higher low over the key zone here at 211. I don't think so. Looks more bullish than it does bearish to me. Even if the market pulls back, I would give it the benefit of the doubt again at 211 here out of semiconductors. If it just continues to grind, all set, 230.50. Moving along to energy, still in range. We'll see if this can't suggest that the recession fears are getting put to bed. A little bit of an uptick there into the end of the week, but if we can get over 82.85 and do something that closes the gap, be a little bit more confident in putting, again, that R word to bed. We won't even say it, as energy is starting to potentially threaten some kind of higher low compression, ascending triangle into the level. 82.85 is a big watch. Let's quickly look at crude. Crude did recapture, at least on Friday morning it did, the $60 a barrel mark. Yeah, look at that, over 60 handle on crude again. If this is, most severe, the best improvement would just be back over something like 66. If we get over 66, call this a double bottom, get back into this range. A little bit more confident in terms of demand for oil. Yeah, put the recession narrative, oh, did I say it? Put the recession narrative to bed a little bit more so, but we're not there yet, right? And obviously, as we get to the Fed discussion here in just a second, Jerome Powell basically said, hey, we're worried about stagflation, right? We'll talk about that momentarily. Anyways, XLK, the strongest, heaviest weight sector we have, most risk on sector, did make a higher high. This gap is still unfilled. I would say that this would look fine. Show me the daily, inverted man ray, call it the head and shoulders, whatever you want to call it, doesn't matter. Show me the higher low to persist over 206.40. Ideal, in a picture perfect world, 210 gap fill reversal, sure. Show me the consensus that buyers are still getting involved. Rock and roll. This is still bullish for the S&P. I would be concerned if the chart started to develop like this. The white dot represents where I would become concerned. Obviously, there's a ways to go before that's in force. XLY, same story, right? So just to maybe speed it up a little bit, same comments, as long as we're over 192.75. Weekly higher lows can persist there. The weekly trend would be reversing. Daily would ideally be over this midpoint, if you will, at 198.50. But so far, this is a bullish indication. It's not leaning bearish there. Short term, sure. Some upper wicks, some rejection of the daily 200, sure. A little bit of a pullback, fine. But generally, the structure, a little bit more bullish than it is bearish. Let's take a look at the XLF. Really strong stuff, right? Continuing to grind in the upward direction, well above the top end of the tariff turmoil zone here. Used it as support, recaptured the daily 50 and 200. Looks good. Even if it pulls back, once again, really open-minded to higher lows, over 48.65. Next up, utilities. Starting a little bit of a breakout earlier on in the week on that Tuesday session, but pulling back into the end of the week. What would this what does this suggest? Well, the market was a little bit on edge as the broad market was balancing towards the bottom end of its range, right? But then on Thursday, Friday, when we made the advance towards the top end of the range, well, utilities dialed it down a little bit. The defensive posture was not driving that market higher. So to me, this is fine. This is great. It's no problem there out of utilities. XLC, as long as we're over 95, not a worry in the world. A little bit of a pullback here would be welcome. Show me the higher low. Show me the support. I would be concerned if the chart developed like this, and we will change our tone back to the bear side if that takes place. But you have to give, in a trend reversal over the moving averages, over key levels, have to give the benefit of the doubt to the buyers to sustain a higher low. Let's take a look at XLB materials. Higher lows in force, equal highs on the table. Ideally, a breakout takes us into 87.60. Remember, lightest weight sector in the market. Not going to move the needle. Healthcare, not a lightweight sector. Down the most. D for defensive. Look above and fail. Look above and fail in the range. We actually talked about this with our trade ideas last week. I think we had AbbVie and Eli Lilly. It worked out fantastic. I mean, look at the way that this has broken down back towards the low end of the range. I think that if the rotation is going to remain true and the market is going to continue to remain balanced, then what you will see is likely this, while tech maybe pulls back, right? If the market is going to break out of the balance range, what ideally you would need to see is the healthcare sector catch support off the bottom end of the range as tech is breaking out, and that will fuel the S&P 500 moving higher. So watch the XLV, big watch here this week as to whether or not 131.75 acts as support. Moving into the XLP, sideways, nothing to really talk about in here. Really, really balanced. It's D for defensive. It's lightweight. Is it breaking out and leading the market higher like this? No. So it's posture-wise non-issue. Let's look at real estate. Holding up over that 41 would be nice. It's also a lightweight sector, not overly concerned if it does lose it. There's plenty of room in here for an arbitrary higher low. Let's take a look at the TLT, the bond, long bond, getting a little bit of a lower high. If you were to just count them from here to here, I would want, CPI is going to make this interesting on Tuesday morning, but if the long bond breaks down into the 85 mark, it would sort of be a little bit of a concern. If really, you could frame it this way. If market participants were like, oh my God, inflation is going to be the worst thing in the world, you would really see this breaking down more aggressively on the tariff front, right? Yields going higher. And this is IEI. This is short term. What is this? 3 to 7? Yeah, 3 to 7s over here on IEI. So you're not seeing that. Let's jump into where were we? Sectors. So let's get back over to the sector ratios. Here we go. And what do we see? If you're not familiar with this dashboard, by the way, check out the video tutorial in the top right-hand corner. Green shoots persist. Green shoots persist. Green shoots persist. Defensive sector is rolling over, not the end of the world. Defensive sector is rolling over, not the end of the world. Defensive sector is sideways. Okay, we'll keep an eye on it. But for now, this dashboard certainly leans a little bit more so to the risk on side rather than the risk off side. As we look at some specialized ratios, green shoots, green shoots, green shoots, really green shoots here, especially with that XLV coming down. ARK-K could use a little improvement, but I do like the sustained hold so far of the potential higher low. We'll see if that can persist over the daily 50 SMA. That's the gold moving average on all of these charts. As we take a look at the what would we say? Sector ratios, risk on off B. It's really gold. It's less sector related, but just risk on off B. We've got ourselves gold on the big lower high. And remember, if I just show you real quick on the gold isolated chart, the gold price itself made much more of an equal high, whereas the ratio made a lower high. That would just indicate to me that even though gold pushed higher, it's less about a risk-off rotation right now and more just of a trade in gold. It's not money, coming out of equities aggressively. Okay, the safe haven asset, let's get the gold, let's get the gold. No, you're not seeing that with this divergence, even though you've made a roughly equal high in the metal itself. If we go over to, let's just go back to B, and let's take a look at Bitcoin, getting back over the $100,000 mark this week. Bullish. It was as the press conference was taking place. Sailor Shift Tool is still green and firmly green into the end of the week. TLT ratio to the S&P breaking down, persisting with a lower high here, much more risk on. So as we go through the indications, now that we've wrapped up the sectors and the risk on off charts, certainly seems like risk appetite is more elevated and this market is more bullish than it is bearish. Let's move into some additional indications on the fundamental front, like the dollar and interest rates. So you can see that the dollar has creeped mildly higher here into the end of the week. 101 is a substantial area. I'd be curious to see how this evolves into CPI. If this starts dumping lower, right, and then we also see rates move higher on a miss from CPI, right, that would sort of be an issue signaling much more of that stagflation, right? When you have the dollar divergent to rates in such a manner, right, like this, the current posture, rates have remained pretty stable as the dollars come off aggressively. You're not really, what should I say? You're just in the market signaling that it's worried about stagflation. That's it, right? Higher rates to combat inflation, but lower dollar on the backside of that. So with that, it's top watch, and Tuesday holds the keys to that. I think that the market's consolidation is mostly a result of the market wanting to see how that plays out. If we look at the inverted ZT as the 2-year, you can see that we're more so just sideways in this range, not really doing much, which is a great segue over to some Fed speak. Over on the Fed watch tool here, we could see that the odds for the June meeting have increased. They were around something like, let's see if we can go to the compare. Let's go to June. We're at June, so this is comparisons. And let's zoom out here a little bit. Why is this so funky on the zoom? Come on, work with me here. There we go. So a week ago, right, you could see that the odds a month ago and a week ago, so a month and a week, were much higher for a potential cut in the June timeframe meeting. Those odds have since basically evaporated and moved into a pause. So the markets, in Jerome Powell was very clear about his more hawkish stance in the press conference. We're going to need to see substantial labor deterioration before ultimately these probabilities change here. And we honestly probably don't even want that. I think the wait and see approach, is we might see Jerome Powell be a little bit too late. That is, what seemingly will happen here. However, I think that he's doing the right thing given the position that he's in. That comment is certainly much more of my subjective take rather than an objective fact. But if we take a look at some of the data here, why is Jerome Powell remaining stable? Well, remember in the S&P from March, they outlined that they're comfortable with the unemployment rate reaching a 4.4% for 2025. As of right now, we just got readings at 4.2%. So the Fed's not going to budge on that. They're like, okay, it's fine, right? Not an issue. And inflation is kind of running cooler than their target here, but the issue is that the Fed thinks that tariffs are going to increase inflation. So without really getting to the point of needing to lower rates, because we're not at the point of a breaking labor market according to their own benchmark, it's sort of like, okay, let's just see if we've beaten our benchmark here, but we know that we need to be at 2% longer run. Let's see if we can get there by keeping rates slightly higher for slightly longer, right? So that's the logic that is what Jerome Powell is basically telegraphing to us in his press conference from the other day, and that's where you can read it in the S&P here. As we look at the calendar for the upcoming, notice that the CPI print is scheduled, like the market's anticipating hotter inflation on the month-over-month print due to tariffs. Right? You can see, and there's tons of economic literature on this. You can go out and read it. Some nerds like myself read this stuff. If you don't want to, that's fine. I'll give you the bottom line. Tariffs are an inflationary thing. Like costs to consumers will generally go up in a higher tariff environment, right? So 0.3% being forecast here is kind of what the Fed's trying to safeguard against. And we'll see how the market responds to either a cooler than expected read or a hotter than expected read. If we get a cooler than expected read, I would imagine that the odds of this dramatically reduce for a pause and increase for a cut, right? The Fed would say, okay, let's, obviously the one-time shock is not here. Again, it's still going to lean this way. It's probably going to go 40% here and remain like 60% over here. And that's just because the Fed has been very clear that one report does not make a trend. Right? That's the new joke. Or it's not really new at this point. Anyways, that's CPI. That is this Tuesday morning, PPI, producer price, is on the Thursday morning session. And once the market has both of these data points, it should be able to forecast a PCE print. And I would be open-minded to volatility from PPI, equally so from CPI here on the Tuesday morning, right? So those two reads in combination give the market a better bearing for PCE later on in the month. Retail sales are baked in there at the same exact time, and we will want to keep an eye on the continuing claims out of the unemployment side of things. If we just go here real quick, Trading Economics calendar always has a little bit better of a breakdown. I should probably just start using this as the baseline. Let's go to Thursday, and let's go to continuing jobless claims. I just want to show you, right? 2 weeks ago, we were somewhat concerned about the breakout that was happening here, right? And yet last week we came back down into the box. So a little bit of reassurance on Thursday that, all right, it was sort of like a false positive there. We're going to continue to keep a very close eye on it, but not really showing all the same signs of deterioration that I thought were going to be heavily influential in the Fed's commentary last week. Let's jump into two earnings insights here. And first one is about guidance. Remember that tariffs, in theory, could have spooked companies into pulling guidance. Now, what we've actually seen with positive guidance, negative guidance for Q2, Infotech, our heaviest weight risk on sector, continues to offer positive guidance, right? You can see 19 reports come in positive, 11 come out negative. This is over the 5-year average, so it's better than the average 5 and 10-year of guidance on the negative front. So companies are not, it seems as though companies are not like, okay, let's just pack up shop, shut down things, and just cower in the corner for tariffs. It seems as though there's still a positive outlook in the market. Now, if I scroll down here, what I want to do is a little comparison. Bear with me as I pull up the right chart. It's right here. We want quarter over quarter. There we go. So notice here that the quarter-over-quarter EPS estimates have been suppressed now for 2 quarters. So Q2 is also supposed to be, as of right now, a downtick from Q1 and certainly from Q4 of 2024. If we compare this, so this is a report from Friday, right? This is data from Friday, the latest earnings. If we compare this to earlier on in April, notice here that Q2 was already scheduled to be a recovery. So when we think about the speed in which markets may recover to all-time highs, you could see based on earnings estimates, it's probably going to be a slower grind in the upward direction rather than a V-shaped recovery. Oh my God, we're going to be there in the blink of an eye. I know it feels like we've been there, or the V-shaped recovery has mostly taken place already, but just going back to the technicals, right, as the market's balancing, I think that's a direct result of some of this happening here on the actual earnings estimates. As we take a look at the earnings calendar for the upcoming week's worth of trade, you get a little bit of quantum, squeaked in there. Some of these more esoteric spacecraft flight companies are going to be reporting. As I generally look at this, I don't see anything that's overly market moving. CoreWeave should be interesting on the AI front. See what they have for us on one of their first reports since IPO. Applied Materials, interesting on the semiconductor front. Walmart is going to be interesting. There's a trade idea on Walmart there that you're going to see in a short period of time. Doximity is going to be cool. I would watch out for that. That's on the AI front. And that's really it. Those are the honorable mentions, but nothing. I mean, Cisco's the old guard, right? So put that to bed. That's really it. Nothing that's overly market moving out of the earnings calendar. Let's get back to what we do best. Let's take a look at our good old technical supporting evidence. Let's take a look at bonds relative to themselves. When I was talking about stagflation, and when the Fed was talking about stagflation, I should have brought up the strike through. Generally, the Fed basically said that, hey, we see that the risks of unemployment rising and inflation rising, they're both higher, right? The risks of them both rising is higher. So bonds are signaling that to us anyhow. You can see that this falling lower would be an indication that the market's thinking the Fed's got to cut because of the labor market, right? But then over here, the longer end of the curve is trying to do the heavy lifting and keep a lid, quite literally, on inflation. So this spells stagflation on that front. That is still the case. We'll make note of that when that breaks, that relationship there. If we look at credit spreads, the shorter end definitely still remaining a little bit more optimistic for equities. The longer end, not quite. A little bit more stable in there. This is not the final bullish indication I was referencing in the intro. As we look at junk bonds in isolation, you can see that they are negatively divergent to the S&P. Remember that this was one of our big calls from last week, midweek, for the pullback to take place in the first place. So just note that you have not broken out yet in HYG, so you might want to continue to carry that forward. It's been pretty accurate over the last couple of months. We looked at Bitcoin already. Let's take a look at breadth. You can see that we have a mild uptick here and here, sort of sideways to slightly lower out of new highs versus lows. That's reasonable considering that the market just balanced, right? There was no aggressive uptick. If there was a big move higher and this remained stable or even lower, red flag, but as of right now, not the case. If we move into the RSP, you can see the same exact thing. The RSP equal weight continues its advance as the market balances here. That's a good thing, right? You just generally don't want to see this divergent where the RSP is doing something that looks like this as the market's doing something that tries to look like this. That is a red flag. This current situation, this and this, not so much. That is fine. So we take a look at the QQQE. It's moving in lockstep, equal weight and weighted. If I just do that, you can see that we're at these previous lower high pivots, all set. That is bullish. If we take a look at, let's get into volatility. The transports have been useless recently. So VIX rolling over, especially on the heels of FOMC in the rearview mirror. If we zoom in there on Wednesday, right, big downtick out of the VIX. It's helpful. It's certainly a step in the right direction. Oops, I skipped one. Cover your eyes. Let's go back to the VVIX. Moving lower, right? And then what I was going to say is, and here is the final shoe to drop, we finally have a backwardation going to contango out of our volatility futures. And it's a very subtle one. It's not really in force all the way. You can take a look at the volatility curve over here. Let's go VIX futures, and let's scroll down over there. So this is the subtle, let's get that off the screen. This is the subtle contango, and then we're back in backwardation, contango, backwardation, right? This is a strong contango over here. What we want is for this to curve like this. If that can be the case, then awesome. The fact that it's starting to do so in the near-term expiries is a good first step. It needs to be more than this. It probably is going to require more positive news coming out of the China talks from this weekend. If we do get positive news, I could easily envision where this bumps up. Really what happens is that this bumps lower, right? This bumps lower and this remains kind of where it is. That's more realistic. But anyhow, point being is that we're getting closer. we're getting much, much closer to a contango, which is comfortable for money managers to start allocating capital back to the market, being a little bit more confident in that approach. Let's take a look at our core list of companies. One-day VIX is elevated. That's probably de-risking headed into the China talks over the weekend. Very obvious, right? An obvious protection play. Let's just say that China talks go horribly. Just buy puts as insurance for over the weekend. That explains away the one-day VIX rise here on the SPX, right? Let's get into the core list of companies and two trade ideas for you. Sorry to get your hopes up. What do we have out of NVIDIA? Really constructive look here on the higher low Brigade bolt that's forming over the top end of the 90-day pause high. If we could stay over 115.25, looking for consolidation to give us some sort of fruitful move into these previous highs back here, 121. Next target is the daily 200 at 125.25. If we take a look at the hourly time scale, right? Liking it so far, Brigade bolt over the level, looking for longs to get back to the highs or equal high breakout to get into that 121. So fishing for longs on this white dot, or this could also be an intraday scalp to the upside. Clearance over 121, a little bit wider of a range starts to open up for bears. I don't like NVIDIA shorts until you get here. Got to be underneath 112.65 if bears are going to make it happen. Next up, we've got Microsoft starting to break, or attempting, I should say, to break the balance highs in here, lower high underneath, look above and fail. I would be targeting the bottom end of the range here if the broad market, keyword, emphasis, asterisk, if the broad market is bearish. If the broad market's pulling back, Microsoft would be a candidate to rotate to the bottom of an end of its range, and then this is a thin structure breakdown underneath 432.25. So Microsoft depends on the broad market direction. On the daily chart, you could see it as a look above and fail, inverted hammer there. The technical break should be underneath that candle's low to rotate to the bottom end of the range. So I'll be watching that very closely here. Microsoft early on in the week if the broad market remains bearish, or flips bearish, I should say. It's not really bearish in its current posture. If we look at Apple, this is just inherently bearish underneath the 201, 90-day pause high, this previous support that could not hold. So I'll be thinking of this as bear flag until proven otherwise. And if this can break down, equal low target at 190.50 is where we want to look. For bulls to be back in play, you got to get firstly over 201, but then more realistically, I'm almost just like, let's just put Apple to bed until it gets back over the 213. If it could do that, maybe there's some thin structure gap close that we can deal with overhead, but the grind to the upside, it really wasn't all that lucrative. Shorting Apple in here, not all that lucrative. So Apple is kind of a slow Moseian stock at this point, and you get much more bang for your buck out of NVIDIA, Microsoft, Amazon, Meta, Tesla. Speaking of Amazon, what do we see over here? You can see the attempt to recapture the big 192 level. I'll be watching that very closely this week. If the trend is going to remain up, you ideally would like to see consolidation persist above that. You've got a couple of nuanced levels in here, but the big one is up around $200.25, daily 200 SMA as well. On the hourly time scale, you can see this, right? Here is maybe like a cup and handle or whatever. Call it a bull flag. Doesn't matter what you want to call it. If you could stay over 192 and out of this range from back here, buyers are in control, and you could look to enter this very similarly to what we talked about in NVIDIA. If you can get entries off the 192, you have very minimal risk. You stop under 192, and you're looking for targets up here towards that $200.25. If that doesn't float your boat and you want a little bit more confidence, this new two-day high, higher low above 194.75, gives you the same rotation, risk and reward. Okay, if the bears are going to come out and play, got to show me. Maybe I'd play it on the double top here. Maybe. I would just be a little hesitant on the consolidation from here. There's a really strong move on that Wednesday session there, so I'm hesitant to short into that. The better shorts would be here when the daily trend actually fails to hold up over this higher low, right? Next up is Google. Daily chart is required here just to continue talking about the bearish engulfer, shutting off 11 days worth of trade from back over here. 2 inside bars. Very reasonable after a large move like what we saw on Wednesday. Let's go back to the hourly time scale now that we understand that. There's really nothing to do until this rallies up into 157. You could look for shorts there. Just be careful on the short there, right? The reason we're saying that it's a possible key level still is because of all the influence we've seen off the level in the past, right, from all this. However, the market moved through it like a hot knife through butter. So although it is a technical level from in the past, I would also keep an open mind that this is thin structure retracement. Okay, so I don't want to get too level happy. You could, in theory, put a level in here at 155.50. Let's just make this dim like we typically do. There you go. If you get over that, you could say, okay, maybe this is the play back up to here. It's a little optimistic. I would need to see a new headline that probably drives that, right? Because there's a catalyst here, it's probably a slow grind higher unless there's a catalyst that says, oops, sorry, false report, false alarm or whatever, which I think odds of that would be pretty slim to none. Move into metaverse, see what's going on with the metaverse. We certainly have bullish consolidation. Let me leave it slightly zoomed out for a second so you can see the importance of this 586 level. As long as we're above that, buyers are in control. This is a balance range. Call it a bull flag, call it whatever you want. Obviously, your next trade to the upside is over 607.25 with a Brigade bolt there. I'd be neutral through here. Where would I favor the shorts? I think I would do it on a breakdown of the top of the gap. I don't think I would do it on a breakdown of the balance range because you've got your moving averages clustered in here, the daily 50 and the daily 200. I would really only look for shorts like this underneath that 571. And that's just the nature of the broad market remaining bullish so far and needing a little bit more confluence underneath the moving averages before Meta actually flips back to the downside, right? So that's that. Let's move along to Tesla. Really strong breakout on that Friday morning session. Shout out to anybody who caught it. If we look at the daily 200, finally breaking up and over, remember that this is a really attractive range to trade for. Don't feel like, okay, I missed the move on Friday. That's it out of Tesla. Tesla usually has a day and then some follow through, right? This is the 90-day pause. It doesn't really count, but here's a big update breaking the 2-day balance range, follow through the next day, right? Here's a little bit of follow through off of a higher low pullback on the gap down over what was a key level at the time. There's the follow through in the upward direction. Here is the first day up to the top end of this balance, right? This is your upside. Never really got follow through on that one. This time around, we are clearing two things, right? This is why I would think that there would be more follow through here. Bull flag and also double bottom neckline, right, from back over here. If we can do that and get the follow through over 303, right, this is where we're thinking about 326.50. So still open-minded to remaining bullish on Tesla. You did have nice volume come in to support that. I'm not a huge fan of volume analysis, especially if it's just volume by time going sideways across the bottom. Volume by price is way more meaningful, but you get the idea. There are people interested in this breakout. This would just be an interest gauge, basically, off the lows. Let's take a look at the hourly time scale. How does this want to play out? Just like every other trade we always take, if you haven't caught the theme by now, the Brigade Bolt is the name of the game. Can you set the higher low here? Can you stay over the daily 200, over 293.50, break the equal highs, and then you could honestly rinse and repeat on a smaller time frame. Hourly Brigade Bolt here, fine. If you can find the entry, awesome. Equal highs the target. If you can't, the next one is like a 5 or a 15-minute Brigade Bolt over something like 303. Okay, target up there, 326. Where does this whole thing fall apart and fail? Underneath 293.50 with consolidation. A little less interested. Let's move along to JP Morgan. Financials, we saw the chart, looks great. Same thing over here. Can we break out through these equal highs? Remains the next question. If we can, great. Big room to run. Some mild levels intraday to focus on, but really 266 is the last major pivot lower high from the all-time high. Moving along to, and where does this fail? I would still give it a higher low over 246.50. So below that is where it would fail inherently. If we take a look at Netflix, what do we see over here? Just some starting to slow down after the earnings run. Typically goes, that's how Netflix typically goes. So balance range highs at 1160. Brigade Bolt above gets interesting. I would not be short Netflix until we're underneath 1102.25, maybe. And that's just because there's thin structure back through here to retrace. But generally speaking, this grind in the upward direction definitely leans more so on bullish consolidation, acceptance towards the highs rather than some sort of quick, snappy rejection and a failed breakout. So not wanting to be short until you're really underneath this zone here, right? That maybe is a trade A to B, but then really at the previous all-time high, you could also say that's a long off that retest, right? So we'll watch for it. The best thing that the buyers want to see is just let's keep this train moving. Let's get something that looks like this. New highs over 1160. That's a tradable idea. Let's take a look at two ideas outside of the core list. One of them is an earnings candidate, so it doesn't have to happen sooner in the week as opposed to later, and that's going to be on Walmart. We made note of this on the earnings calendar just a moment ago. Look at the clean bull pennant here. You could call it a pennant, a flag. Doesn't really matter what you want to call it. Higher low perhaps persisting with the doji on Friday over 96. If we could spot entries over 96, clean like this, back to the 99.65, maybe a pre-earnings run-up. Ideally, this would be a trade for people who don't want to use options because your IV is going to be a little elevated as we come into earnings out of Walmart. But the idea, the structure is very clean. And honestly, there's not a lot of setups happening across the market right now. A lot of things just stuck in balance without clear, like, okay, we got to hold this, break this, do that. So Walmart's one of the clean ones, but do just be mindful of your earnings coming up here. Let's take a look. After Walmart, we had, Uber, UBER. This is a longer term idea. Earnings are in the rearview mirror. Obviously, Ackman's got his big stake in this. It's a popular name as of right now, also among retail. So if we can get out of this base, which is what we're trying to do, holds of 8180 look pretty constructive. Let's go back down to the hourly. Look at what happened into the end of the week. Break above, mild pullback above that. Looks like those lower wicks coming in, continuing to indicate that people are trying to buy this pullback and not so much sell into it. For me, any sort of like longer term shares I have in Uber just gives me confidence here. Maybe you could try to trade it as a flag breakout if you don't already have exposure, right? Something over it. You could use a trend line. You could try to enter close to 81.80. You could try to put a stop here and, balloon it back to the equal high at least, if not follow through higher. Generally, Uber, I like the structure on the daily, on the weekly. It's not something that needs to happen in the blink of an eye. You could say that you want to clear this equal high pivot up here at like 86.65. There's a number of ways to trade it, but I did like the beginning stages of this chart breakout. Certainly worth talking about the hold into the end of last week. Speaking of this just came to mind because I was looking through some charts this morning. If you want something similar, here is CROX. Not that I would say like... I'm not a fundamentalist, right? But it would just seem kind of odd to me that you would invest in CROX footwear. Their margins, I think, are astronomical. There's other components of the business. Anyways, point being is that you have this long-term base. Now, the difference between CROX and Uber is that Uber's base is towards the highs of a multi-year, cup and handle sort of thing happening. So CROX is on the lows, but it does have this big earnings gap overhead that it could potentially close. Here it is on the daily time scale, and then I'll leave you to your own devices as to whether or not you want to trade footwear or a car network that is on pace to replace taxis and many, many other things. You make your own decision. So if you want to put it in sport mode, or if you want to fire up some Uber Eats, DoorDash, whatever, be my guest. But those are your 2.5-ish trade ideas for today's session that I've got for you. With that, we will be live, as we always are, every morning, 8 o'clock Eastern Time. Remember, this week we do have the CPI and PPI, so some inflation metrics coming out. We'll be live in the pre-market prep, taking a look at how the market responds in real time, giving you my thoughts on how the market's responding to either a hot print, a cool print, the whole 9 yards. We'll be up in the office, getting the job done, as we always do. Hope to see you there. With that said, have a green trading week, and I will see you in the next one.